The global economy is rebounding from its worst downturn in living memory, but paths out of the COVID-19 trough are diverging, mainly due to large differences in virus containment success. The state of Victoria and the US Sunbelt states are contending with large new COVID-19 cases and tighter restrictions on activity, which risks wiping out their recoveries and spilling over into their national economies. Meanwhile, the virus is still smouldering away in a handful of regions across Europe, but it hasn't been so problematic that it has imperiled their recoveries or brought about meaningful new lockdown measures. China continues to have cases under control, and there are still a handful of places, such as New Zealand, that remain mostly virus-free. The rapid pace of developments has meant that traditional economic data is less insightful than usual, so observers have been using new alternative high-frequency mobility data to get a timelier lens on recovery prospects. For example, Google's daily mobility dataset is one example showing how people movement has changed during the pandemic. As you can see here, Australia's eastern states all showed a broad recovery in people returning back to work, but in the last month there has been a considerable divergence, with Victoria falling well behind New South Wales and Queensland. High-frequency alternative data also show that the US recovery has faltered as well compared to Germany, consistent with Germany's success in flattening the curve, whereas in the US, we're still seeing an uncontained outbreak. These variations are set to grow in coming weeks and months, with important implications for stimulus efforts, interest rates and currencies. In Australia, PM Morrison said that Victoria's Stage 4 lockdown could shrink GDP by $7 to $9 billion in Q3, and the overall impact, together with prior restrictions in Melbourne, could cost between $10 to $12 billion. That's around 2.5% of GDP. Also, unemployment could peak at around 10% rather than 9.25%. The deterioration in Australia's domestic prospects might have been expected to weigh on the Aussie dollar, but by and large, the Aussie dollar has shrugged off these considerations. And as we speak, the Aussie dollar is trading at 18-month highs above 72 cents and remains very strong against the Kiwi and the Euro, places that have flattened the curve. It's clear that bigger global trends are driving the Aussie dollar higher instead of these domestic considerations, most notably the sliding greenback and ongoing strength in commodity prices. A major bear trend for the US dollar has been unfolding lately, a development that no currency, including the Aussie dollar, can resist. The Fed's strong dovish resolve has been a key factor here, and next month's Fed meeting could extend the dollar bear trend further. The Fed has been conducting a policy framework review, and judging by recent Fed speak, it appears that the Fed will adopt a new policy of average inflation targeting. Under the Fed's current framework, there is no compensation for periods when inflation is above or below 2%. But a shift to average inflation targeting would see the Fed commit to making up for periods when inflation is below 2% by deliberately letting inflation run above 2% for a while. In practice, that could produce more easing from the Fed and an even more extended period of accommodation. Meanwhile, prices for Australia's key commodity exports continue to firm. Iron ore prices, for example, have risen another $10 a tonne over the last month to $112 a tonne. That's a one-year high. It should be no wonder then that the Aussie dollar remains firm. Next week's local calendar is an important one, including the NAB's Business Survey, Westpac's Consumer Sentiment Survey, Q2 wages figures and the July labour force figures. We'll speak again next week.